clearly if you were buying loans, tertiary and secondary loans in the UK 3 years ago, the assets underlying those loans, the prices have fallen. But then, today I think there's more competition for the books that are currently out there. So therefore, are you buying at more pence on the pound? So you've got to work the graphs and work the crossover points. But yeah, listen, I've heard rumours on some deals of, the guys who bought the loans now looking to sue their valuer. So, it's not all roses.
No, and on a portfolio, it's almost impossible to accurately value the underlying assets because you can't do that level of granular analysis. You don't have the information anyway. And they're inherently difficult to value, sort of secondary assets in provincial towns, a lot of them. Sometimes there's mispricing there because in certain jurisdictions you may actually get more value by selling into the local market, but it's easy to get the value wrong. And I think some of these guys extrapolate from auction prices in the area, which I think they monitor on a real-time basis. But again, there's a big difference between what you get on a particular auction and the specifics of an individual property.
So I get that. These are all the reasons of why would people have underwritten these deals won't make as much money as they thought they would. But just one of the expenses that we have, which may not outweigh this sort of headwind, is when you are facing Lloyds, the EIB, Bank of Ireland as a bank, the borrower behaves somewhat differently than if it's one of the big US private equity funded deal. I think we've seen situations acting for borrowers where, frankly, prior to a few phases in that, when this loan trade started emerging, we had borrowers we were acting for saying, actually, I'm going to buy my loan at 50 pence in the pound. There was then subsequent rumour that the bank may be selling their loan book they thought they were in. Subsequently, that offer went up to 75. They were not even in the portfolio. So actually, I do think the psyche of who you're talking to somewhat drives different economics. So that's not to say that the underwriting is perfect. It never quite is. But I do think actually there is a lot of good news in some of these portfolios. Where I do get really worried is where you see now the latest trend is starting to sell minority positions as highly structured positions. So AIB sold their position into the Aura Hotel. That's a public put to a US hedge funds. I forget the name, Kemper, I think. I'm a bit worried about that because I do think actually the value drivers forget about whether you value the collateral properly. I mean, this is the sort of a dark art now to try and consider. One, what is it worth? Two, do you understand the security structure position? Okay, right, maybe you can. Then, how are the rest of the syndicate going to behave? That's an interesting one, because you have no control in some of these positions. And these are not necessarily liquid pieces of debt as you would expect in the CMBS market, for example. So I wish them the best of luck, but I do worry as to how one can make money in these positions.
I think that's more like a sort of hedge fund market where you're almost buying an option, and a bit like buying B notes in a securitisation, where it's completely different dynamics. It's not sort of cash flow, it's not income driven.
Yeah. And
you're just arbitraging a situation to extract an exit value. So I agree, it's difficult to know how that will work out. It's a different kind of market in a sense.
Yeah, the prices that I've seen, I think, are a lot. Well, the prices I've heard are a long way from ransom strip pricing. They are pricing that seems to reflect quite a strong collateral value. There hasn't been that many. I think there were Lloyds sold out of Moran and Booley's back in last year. There was the EIB trade. Seems to be two hotels, and I'm sure we're missing a lot of them. But I do think these will be real hard work to extract value from.
Well, in some ways, Isabel was sort of conceptually a bit like that, in that they were selling a lot of syndicated positions at different places in the capital stack. But
I think they're very interesting deals, though, because you're right, I think it is dark arts, but these American distressed hedge fund buyers are very aggressive and are on the phone pounding every day. And you look at some of the successes. I mean, people will know better than me, but in the house building sector, house building was just horrendous 2-3 years ago. Look at Varde buying into Crest Nicholson, and now Crest Nicholson's IPO, and there's some very interesting situations where you can get into an underlying reasonably high quality operating business through a piece of debt in a minority position, work very hard, get noisy, hoover up the other minorities, take it over, list it. I mean, that's a fabulous, Crest Nicholson's a fabulous example of how Varde's made a ton of money. So, you know, if you can do that in commercial real estate situations, good luck to you. But what you probably need is hotels or healthcare or self-storage. You know, the deals that'll work is where you've got a decent underlying operating business that's stressed from a wrong capital point of view. But if you get those right and you play the Harry Potter card, you'll make money.
Yeah, that's two big ifs.
And do you think that's what we'll see more of, increasingly, those kinds of, because there's been successes, proven successes, that there'll be more of those kinds of deals coming through, particularly with the US money coming into the European market?
Yeah.
But
I think that I completely agree that the sort of the risk on those is way higher because of the complexity of what you're dealing with. But so therefore, if you get it right, you might make a ton of money. If you get it wrong, you lose your shirt. I mean, I think it's pretty binary.
Okay.
We've seen some investment banks like Goldman's do that, actually. They're focusing on loan portfolios secured over operating businesses as opposed to pure real estate loans, but where real estate is an important part of the operating assets, the underlying business, and usually in JV with a private equity fund.
There's Lundy.
Lundy's an example of a TPG.